Not everyone is required to file a tax return, but the rules for who actually must file are not what most people think. Guess wrong one way, and you can get hit with a penalty. Guess wrong the other way, and you walk away from a refund that was yours. This is the real answer for the 2025 return you file in 2026. Let's break it down. Whether you have to file comes down to 4 things: how much you made, your gross income, your filing status, your age, and whether someone else can claim you as a dependent. Change any one of those, and the answer can flip. So let's take them in order, starting with the rule that covers most people. Here's the general rule for most people. If your gross income for the year is at least your standard deduction, you generally have to file. That makes sense, because the standard deduction is the amount you can earn before any of it is taxed. Earn less than that, and for most people there's no income tax, and often no requirement to file. So what are those numbers? For the 2025 tax year you file in 2026, the standard deduction is $15,750 if you're single, $31,500 for a married couple filing jointly, and $23,625 for head of household. Make less than your number, and the general filing rule usually doesn't apply to you. But here is the trap that catches more people than any other, and it has nothing to do with that threshold. If you had $400 or more of net self-employment income, any gig, freelance, or side hustle profit, you are required to file a return, even if your total income is far below the standard deduction. $400. That's the number almost nobody knows. And this isn't our interpretation, it's straight from the IRS. This is Publication 501, Who Must File. Right here it says, if you're self-employed, you must file a return if your gross income from self-employment was $400 or more. That one line catches a huge number of gig and side hustle workers off guard. Why $400? Because of self-employment tax. Even when you owe little or no income tax, you still owe Social Security and Medicare tax, that 15.3%, on your self-employment profit. So $500 of DoorDash or freelance income means you have to file and settle up, even though your income tax might be 0. Now, dependents play by different and lower rules. If your parents or someone else can claim you as a dependent, which is common for students and teenagers, you can be required to file at much smaller amounts. So don't assume that because you're claimed by someone else, you're off the hook. Here's roughly how it works for a dependent in 2025. You generally must file if your earned income from a job is more than $15,750, or your unearned income, like interest or investment income, is more than $1,350, or a combination crosses the limit. That unearned income number is low, so a dependent with investment income can owe a return fast. If you're 65 or older, or blind, you get a higher standard deduction, which means a higher filing threshold. So seniors can earn a bit more before they're required to file. The exact amount depends on your status and how many of those boxes apply, but the direction is simple. Older threshold is higher. There are also special situations that force you to file no matter how little you made. If you owe self-employment tax, took money out of an HSA or retirement account early, owe household employment taxes for a nanny, or received an advance premium tax credit for marketplace health insurance, you have to file to settle those up. These override the income thresholds entirely. Now flip it around, because this is where people leave real money on the table. Even when you are not required to file, you often should. The most common reason: if any tax was withheld from your paychecks and you don't file, the government simply keeps it. Filing is the only way to get your own withheld money back. And then there are refundable credits, the ones that pay you even if you owe no tax at all. The earned income tax credit can be worth thousands. The child tax credit and education credits can put money in your pocket. But here's the catch: you only get them if you file a return to claim them. Skip filing, and you forfeit every dollar. Let's make it concrete with 2 examples. Example 1. A college student with a part-time job earning $9,000, claimed as a dependent by their parents. That's under the threshold, so they are not required to file. But about $700 was withheld from their paychecks during the year. If they don't file, that $700 is gone. So they file anyway, purely to get their refund. They get the $700 of withholding back, and if they paid college tuition, an education credit could add even more. 5 minutes of filing turns into a real check. The lesson: low income plus any withholding almost always means file, even when you don't have to. Example 2. A side hustle. You made $6,000 of net profit driving and freelancing, with no W-2 job at all. $6,000 is well under the standard deduction, so it feels like you're in the clear. You are not. The $400 self-employment rule applies, so you are required to file, and you owe self-employment tax on that profit. The self-employment tax on $6,000 of profit is about $848. That's due whether or not you ever got a form. Ignore it, and the IRS can add a failure to file penalty and interest on top. Filing isn't optional here, but the good news is your business deductions can lower that number before you pay. So what happens if you were required to file and you don't? The failure to file penalty is 5% of the unpaid tax for each month you're late, up to 25%, plus a separate failure to pay penalty and interest. That stacks fast. If you were actually owed a refund, there's usually no penalty, but you've got a clock running. And here's the rule that quietly costs people the most. If you're owed a refund, you have 3 years to claim it. File later than that, and the refund is gone forever. The government keeps it. Every year, hundreds of millions of dollars in unclaimed refunds expire this way. If money was withheld, don't sit on it. So here's your simple system. 1. Add up your gross income for the year. 2. Compare it to the threshold for your filing status and age. 3. Apply the $400 self-employment rule. Any real side hustle profit means file. Quick recap. Most people must file once their income hits their standard deduction, but $400 of self-employment profit forces a return on its own. Dependents and seniors have their own thresholds. And even when you're not required, filing is often how you get withheld money and valuable credits back. When in doubt, file. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, don't assume you're too small to matter, and don't leave your own money behind. Check the thresholds. Remember the $400 rule, and when there's withholding or a credit on the table, file even if you don't have to. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.